set in the system now. So remember, that's the chapter before, not the one we're covering now. And then I bumped up the chapter 18 homework. What did I make it? The Wednesday or something? Wednesday night? No. Yep. But you got the test for chapter 17.
Wall Street Journal's due Monday?
And Wall Street Journal's due Monday, yes. All right, so any comments on the Fed tour?
Loved it.
Loved it? A good time? Oh, that was a fun time, yeah.
I gotta make them.
They do not print them. They just collect it and dispose of it. Yeah, that was kind of interesting. Even they'll report how much they destroy. Who asked that question? That was kind of a good question. Was that Derek who did that?
There was a.
I think it was Derek.
On the biggest hit, like they destroyed over like I believe $1 million or more than
$1 million a day.
Yeah.
I wouldn't. So he keeps track of it. No, that's why he said that it was $1 million somewhere. So yeah, that was interesting. That they report it, but it doesn't mean that it automatically gets reprinted either. So it depends on what's going on with currency. Let's see. I got the same recording. Okay. Anything else?
I heard you and Greg were talking to the guy misquoted something.
Oh yeah, yeah, that's correct. Who'd you hear that from? Me, or did I mention it? I mentioned it to people who traveled in our car. Yeah.
You and Greg were talking.
Yeah, and we taught you right. We mentioned it at
I think that's what it was.
thing to each other. So what he screwed up was the leading and lagging comment about wages and prices, and actually it was right in the data that he had too. So the wage data, let's say, did this, and the price data did this. And if you remember, he said, he kind of narrated a story that, it's kind of funny because this is what the media does a lot of times too, right? You can narrate a story that you kind of shake your head and like, oh yeah, that makes sense, whatever. He said that wages go up, people have more money, then they go to the store and they bid up prices. And so wage growth or wage changes were leading price changes. He didn't say it in that many words. You guys remember that part? On the wage, he had a graph up like this, but he wasn't very good even at putting his graph because this was time. And so as we're traveling through time, he had it backward. I think I did this backwards. That's how I worked out, but this one is bottoming out first, right? This series is bottoming out first, and then this series is bottoming out if you go through time. And so this is the leading thing, not the lagging thing. This lags this, or this leads this, is how we look at that on a time series data. And so his data was right, but he price changes lead wage changes. And so that's some of the fairly big news today, is that we've seen the highest wage growth since the recession in 2008. This quarter, wage growth has finally increased. So that is one of the latest things. So that's the whole thing. Changes at the store happen first, and then wages trail behind with adjustments. Okay, anything else? Comments, questions? Yeah.
Did you do that job before you came on?
I did. That's part of what they said on the wage growth. I didn't look at the rest of the jobs. Was it 160 something? So it was an increase in job. I don't know did they say what the growth rate was, or?
I think it was down a little bit, like.
So the unemployment rate dropped again a little bit because of that. Yeah, I didn't see the full thing, but I caught the part of that story with the wage growth. Yeah, so little signs of something there. Of course, it's funny how those media announcements go, because last month it was actually down, and it was surprising that it didn't. And sometimes you got to watch out if it didn't grow by as much as expected. So it's still growing, but not as much as expected. So then they give kind of this negative spin on it. So it is important as you guys start to understand some of these statistics to kind of listen closely to how it's portrayed, because again, statistics don't lie, but liars use statistics, right? So kind of listen to the message that they're coming across with. If you're a Hillary supporter and you're trying to use those statistics, do you put a positive spin or a negative spin on the way you present it? Positive. Why? Because there's a Democrat in office, that's right. So if we start to feel better, like, oh, Obama's stuff is finally working and the economy's getting better, then it's like, well, we might as well keep it going with Hillary, right? And so that's kind of the message. Whereas if you're a conservative supporter, you might take those same statistics and somehow put a little bit more of a negative spin on it, because then their argument is going to be, the economy's not doing good, do you want another 4 to 8 years of this type of economy, blah, blah, blah. So again, that's why it helps to be an informed citizen so that you can think about those statistics. Okay, anything else? All right, so let's get going on a little supply. Oh, wow, I forgot my golf club at a very important time. One of the times we're going to use a little golf club here, a potential use for a golf club, in the market for reserves. Okay, so the focus of this chapter is on the federal funds rate. So federal funds rate.
Good chapter 18.
This is chapter 18, yes, which we've talked a little bit about, but we mostly had our thing we did on Monday, and then we had the Federal Reserve tour, and that's part of the reason we kind of bumped this stuff up. So federal funds, who's loaning to who at what rate? What kind of lending is going on at the federal funds rate? Bank to bank, right? Not Federal Reserve Bank, but this is bank to bank lending. Is this for an expansion of their building, kind of a 30-year new building, a new bank building that they need to do? How long a term is this type of lending? Very short term, like 1 day possibly, or 3 days, or a week. So usually this is bank-to-bank lending, very short term.
The bank that gets lent to, they don't pay back.
Like 1 to 5 days would probably be a normal. What's that?
So like the bank that gets the loan, they're going to pay it back.
They're going to pay it back in a day. Sometimes it's just an overnight loan. Why are they doing that kind of lending and borrowing? Let's stick on the borrowing. Why would a bank need to borrow for just a day? Hey man, I just need a little fix to tide me over.
So they can stay within the reserve requirement?
Yes, because they might have fallen short on required reserves. So that's the purpose of it. And this is to meet required reserves. So one bank has a large outflow of cash because a very large account came in and withdrew some money. At the same time, they made a huge loan out to another person, and all of a sudden they're kind of threading the needle, basically used up all their excess reserves, and they're dipping into they went under. They know on a given day when they have to meet their, I don't remember the details on this. It's like at the close of business, so probably 5 p.m. depending on the time zone they're in, they have to have required reserves met. And so what they'll do is they're like, oh crap, we need 10 million. Let me go to Chase. Hey Chase, give me a loan for 10 million for today. I should be good just a day and I'll pay back 10 mil tomorrow. Literally, that's the type of deal that goes on. Then Chase makes a loan to that bank. Tomorrow comes by, they have an influx of cash like they were expecting or something. Maybe they were going to sell some bonds that they didn't get quite put into motion, or they had to wait on the sale for some reason. And so they just go and make that short-term loan. So that's the federal funds market and the importance of the federal funds rate. Yes? Yes, that they're paying the federal funds rate. So that is the rate charged. So it's bank-to-bank lending. I guess I didn't really say that. Bank-to-bank lending is done at the federal funds rate. So in other words, that is the rate that they charge. They totally negotiate this between each other, by the way. Remember, the Federal Reserve doesn't set the federal funds rate. What do they set, though? They do set the discount rate, that's right. And what else do they kind of set that's related more directly to the federal funds rate? The percentage of the required reserves is something they set, but that's not related to the federal funds rate directly. Turns out, we're going to learn later, that it can influence it, but it's not direct. They set the target, the federal funds target rate. Now, the guy showed us, the first guy we talked to, I think he had a picture of this, where well, that might have been inflation target or something, but where the target rate, no, I think he did maybe show us this. The target rate looked like this, and the actual rate kind of fluttered around it. Remember that graph? So the Fed sets their target of what they want it to be. And by the way, their discount rate is typically X% above the target federal funds rate. So the Fed announces, we're going to target federal funds to be at 1%. And then their discount rate is usually determined by that. We're going to do a prettier picture here in a little bit, or hopefully prettier. The discount rate is a fixed amount above their target rate. So they're going to say, our discount rate is going to be a 0.5% basis points. So my target rate is 1%, which then automatically implies that the discount rate is 1.5%. Okay? That's kind of how they set their policy. But the actual federal funds rate is negotiated between the two banks. And, it kind of ends up, well, what do you want to do? Well, how about we do 0.85% tonight? That's what I'm feeling good about. And so they just negotiate out that rate. It's a little more known. I think they kind of have it published or something. But that rate potentially is different from bank to bank. So if two banks have a relationship with each other, maybe they would give a preferential rate to one bank and over the other or something. Okay? Any other questions there? All right, so let's see here. Let's jump right into a picture. Let's see, I'm going to get rid of this one. We're going to make it similar to that. All right. So let me start you off with a demand curve. And so this is going to be a quantity of reserves. And so we've got two types of reserves, borrowed and non-borrowed. Borrowed reserves and non-borrowed reserves. We talked about these before. So what are borrowed reserves? Who are we borrowing from? Had to do with Chapter 17, which I guess is the test coming up Sunday. The Fed, right? So these are borrowed reserves from the Fed. If you borrowed reserves from the Fed, then you did that at the discount rate, right? So borrowed reserves are at ID, the discount rate. So discount loan from the Fed. And then that means that there's other reserves out there that are, if we look at the total number of reserves, it's required reserves plus excess reserves in aggregate, right? From the bank's perspective, now this is from the bank's perspective, they're told the Fed how much they have to have, and this is how much they have potential to loan out. The story that I just told you, that at the end of the day, our bank's running short, oh crap, and we're not going to meet our required reserve ratios, would mean that you have some reserves yourself, you have some non-borrowed reserves, but then you also had to go to the Fed maybe or another bank and borrow from them, right? So that's the type of thing we're picking up on. And the one that we're focusing in on the most is this non-borrowed reserves, which the Fed creates through open market operations. So non-borrowed reserves are influenced through open market operations. The purchase and sale of bonds. All right, so the supply of money, you might remember, looked like this when we did money supply. Remember, that's different than reserves. But the money supply, money demand, remember we had that little picture, money supply, money demanded. Don't be confused by this. This is the full quantity of money in the banking system with interest rates being measured over here. And then we also did bond demand and bond supply, BD, BS. And what was measured over here, we had the quantity of bonds. What was on the vertical axis for the bond market? Interest rates, or what? The price of bonds. They were one and the same. Remember, as the interest rate went up, as the price of bonds went up, the interest rate went down. So there was that one-to-one connection. But this was really the bond market. And this here was the money market. And we talked about an open market operation that would increase the supply of bonds, putting downward pressure on the interest rates. Well, we're peeling back the onion and we're looking in more detail by looking at the reserves that are out there. And so the quantity of non-borrowed reserves is controlled by the Fed. All right, and that's the supply. All right, so the reserve supply curve looks like that, and the reserve demand curve looks like this. The people who are demanding reserves would be the ones that might be falling short, remember. And the intersection of the reserve supply and the reserve demand is the equilibrium federal funds rate. So now this is where I could use my golf club. If there's a change in the demand for reserves, then interest rate, federal funds rate will go up. Remember, the federal funds rate is the rate that's being charged banks. It has nothing to do with the Federal Reserve per se. On a day-to-day basis, there might be changes here. All right, so here's where the fun kicks in on this market. Well, I don't know if it's fun or not. But this one has an elbow, and this one has an elbow. Yes?
What is the other one again? The not the non-borrowed reserves, the other.
This line?
Yeah.
This is the demand curve, the demand for reserves, which I'm going to define now that I put my elbows on here. So this is the reserves demand, the demand for reserves, and the supply of reserves. All right, at the top part of this elbow, let me start here. This ends up being the discount rate. So we're measuring interest rates over here. why is this the discount rate? And why does there end up being an elbow going out here with the supply of reserves? So the discount rate is what interest rate for who? Banks to the Fed, right? So they go and get a loan from the Federal Reserve Bank. The federal funds rate is the bank-to-bank lending, private bank to private bank, right? So private bank to private bank. This one is from the Fed. So what's the deal? Kind of imagine this thing drifting up. Federal funds rate is starting to increase, right? And then what happens when we get right up about here? What happens?
If there was a higher.
Zach, I'm sorry, let me go Zach.
Banks become a different borrowing.
Good, good. So at this point, as long as there's no penalty, for borrowing, if we're at this point here, the bank is now indifferent from borrowing from another bank or borrowing from the Fed. If it continues to increase, say here, this would normally start pushing upward pressure on the federal funds rate, but nobody would borrow from a bank any longer. They'd just go to the Fed. And that's our elbow. So when we have an increase in demand going out this far, the discount rate creates an upper bound for the federal funds rate. Because no bank in their right mind would go pay more when they could just go to the Fed for it, right? Since I almost don't have to tell you guys this anymore, but in the old days, there was kind of you were being a bad boy or a bad girl if you had to go get a loan from the Fed. It was kind of like getting a loan from your parents, right? You're in trouble, right? So the Fed tried to take away that stigma and said, it's okay, you can come to us, we'll loan you money. But you gotta be careful sometimes, right? If your mom and dad say, it's okay, you can loan some money from me. It's kind of like, what do you want? I don't want you to know what I'm doing with that money, right? Sometimes you've got control over me or something. But nonetheless, that's been how the markets worked here with this new regime since 2008. All right, so questions on that? The other thing that happened, well, this is really more of the 2008 change, is this lower bound. This is IOR. And what IOR is the interest rate paid on reserves. So the OR is on reserves. The Fed now, since 2008, now pays some interest on reserves. So they really created, remember how we've been kind of hammering 3 policy tools, which were open market operations, discount rate, required reserve ratio. Now there's actually a 4th one. I just didn't tell you about it before because we don't need to confuse things any more than we already had. And that is to change the interest on reserves. That's another one that they have under there. So it's kind of this 4th little wild one that they haven't had to do anything with for the most part because the federal funds rate and the interest on reserves have been basically at 0. So we've kind of hit this lower bound. So that it hasn't really come into play very much since it was originated in 2008. And we've been in slow growth, no monetary policy type environment ever since. But here's how it's supposed to operate, is that if the demand, again, came down so low that we were down here, then nobody would do any more borrowing or lending because you're going to get a better interest rate from the Fed on your reserves than where you were before, if there was a change there. So now we've got this upper bound and lower bound created in the market for reserves, both set by the Fed. The federal funds rate, again, is not set by the Fed. They do set a target. So what the Fed is doing is trying to keep the federal funds rate in some sort of range. And how they do it is by having the ID and the IOR down here. All right, questions on the setup? Yes.
What is the target rate, you know?
Well, it's at like a quarter. They raised it from 0 to a quarter last year. So it's been at a quarter, was the first movement that they had done. So that didn't make this, so when you guys read the book here, it still says that the federal funds rate was at 0. But that was the big thing. That's where I was fortunate enough to be. It was a huge announcement in last December when I was with Wayne and I went down to the Capitol building, that story. They were interviewing him. He was recommending that they raise it to 0.5%, but they only raised it to a quarter. So that's where the federal funds target rate is at currently. But the actual federal funds rate then, you know, fluctuates around. Okay, anything else? All right, let's see here. So let's look at some changes. Let me come over here. So changes in equilibrium. Let's take a look. So how about number 1? So changes to market for reserves. So number 1, open market purchase. Open market purchase. Let's just draw a quick little graph. Let's start to get good at these now. Reserve supply, reserve demand. NBR1, FF1. I guess your text uses the IFF. Okay, so this is our home base. Open market purchase. Increase the money supply or decrease the money supply? Increase. The attempt that it's trying to do is increase the money supply, right? So you can kind of use the same logic here. Is that an open market purchase of bonds? Janet, being myself, I won't even pull $1 up. Janet goes to the market. You guys have the bond. I'm going to go purchase the bond. The bond comes out of the market. Kurt's left with my wallet. Don't move, go anywhere. Okay? So open market purchase leads to an increase in the supply. And so now that same thing's going to happen here. What does the shift look like with this weird elbow? What does the shift look like with this weird elbow? A shift to the right, or kind of a shift to the right and down, or a shift to the right and up, or something weird when we have an open market purchase. Shift to the right, and what about this upper part? It stays. So the shift is going to look like this to RS2. And I'm just not drawing it quite on top. I didn't mean for that to come down. So it's at the same level. So in other words, the discount rate hasn't been changed, right? That's set by the Federal Reserve, and neither has the interest on reserves. That hasn't been changed either. All right, so then in this case, the interest rate will shift down on the federal funds rate will fall to IFF2, something lower. So what if they shifted a whole bunch to here? And then this is going to be color coded here. NBR2, the level of reserves have gone up. What if they do it even more? We get the same thing. RS3, NBR3. But if we started here, there'd be no effect on the federal funds rate because we've hit that floor, right? So if I look at another shift, well, it would fall from here to here. What I was trying to accomplish, maybe even one more, just for fun. RS4 and BR4. Moving from 3 to 4 causes no change because the federal funds rate for 3 and 4 are all equal to each other. Incidentally, I might add that you might go to another bank for that loan, but the bank will never be able to charge less than the interest on reserves anyway. So there might still be some bank-to-bank lending going on, but it's truly at this rate because they know they could go to the Fed if they wanted to. All right, so open market purchase now has this effect. And depending on where we started, we might end up at a new federal funds rate, or it could stay the same depending on where we started. Okay, questions? All right, so an open market sale, I'm not going to do, because it'll just be that graph in reverse. But it's possible that there could be an open market sale. Yes?
So Federal Reserve keeps the banks in check so they don't in that range, so they won't make too much profit. Or...
Well, you don't want to necessarily think about it being profit, but yes, it does keep, it effectively bounds the federal funds rate between this range. So it's not so much about profit making, but about trying to either encourage or discourage lending is ultimately their motive. What's the dual mandate of the Fed? Price stability and low stable inflation is kind of the price stability. What was the other thing? Unemployment. Now bear in mind, do any of those have interest rate? No. Inflation, unemployment. Here we are talking about interest rates. So you got to remember those connections. When interest rates are low, what happens to unemployment in theory? What are we trying to do? If the Fed is keeping interest rates low, unemployment should go down, I mean in theory, because there's more lending going on, right? So it's supposed to stimulate, it was an expansionary monetary policy. So that's the goal of it. But the fear is that in order to lower interest rates, there has to be an expansion of the money supply. And if there's more cheap money floating around, it might destabilize inflation. It might lead to increasing prices. That hasn't happened in the United States. That's why they've continued to have these low interest rates this whole time. We have not seen the inflation due to people not loaning out money, the excess reserves, and possibly holding more cash. All right. Anything else there? Discount rate. Number 2. So open market purchase, if you want, maybe just put a little note to yourself. Note, sale has opposite effect. Number 2, discount rate. Change in the discount rate. We got RS1, and we've got RD1, quantity of reserves, non-borrowed reserves, equilibrium federal funds rate. There we go. There's our home base. What is the impact on the federal funds rate when there's a decrease in the discount rate? What is the impact on the federal funds rate? It goes down? So you know, Kimmy? When it go up? Stay the same. I think we covered all our bases now, so that's good. All right, so change in the discount rate, a decrease of the discount rate. If we're gonna, let's suppose there's a decrease in the discount rate. The discount rate is currently, let's call it 3%. If the federal funds rate is currently at 1.6%, discount rate is decreased to 2.5%. What happens? Nothing. Yeah, nothing. So if the discount rate is dropped to 2.5%, so let's see, 2 is 2.5 here. RS2 looks like this. ID2. Here's ID1. It has no impact. So a change in the discount rate doesn't end up impacting the market for reserves. Now, if it was lowered to R3, now we have an impact, right? So if ID3, if it was lowered all the way down to there, now we've got a new intersection of federal funds, and we'd have MBR3, and the federal funds rate would be the new discount rate. All I'm doing is raising the flag, lowering the flag through discount rate maneuver. So only if the rate is dropped far enough below the current equilibrium would it have any impact. All right, questions on that? So these are kind of fun with the elbow thing going on here. All right, number 3, change in required reserve ratio. So quantity of reserves, boom, reserve supply, reserve demand, equilibrium at some initial starting place, quantity of non-borrowed reserves in the system. These anchor the current discount rate and the current interest rate on reserves. So, what if there's an increase in required reserves? So tomorrow, Janet says, gotta hold 20% now instead of 15%. What happens in our, is it gonna affect reserve supply or reserve demand? Demand, right? So the banks are required to hold more reserves, so there's going to be an increase in reserve demand. To RD2. Again, the interest on reserves was assumed to be held constant. We didn't change that. We didn't change the discount rate. All we did was we changed the reserve requirement. The people who need reserves need more of them now than they did before, and that causes the federal funds rate to go up. In the good old days when we were talking money supply, was that a contractionary or expansionary monetary policy? Contractionary or expansionary monetary policy if you did an increase in the required reserves? Contractionary, right? So we're decreasing the supply of money. Now you kind of see that filtering through the federal funds rate, right? So by increasing the required reserves, it raises the federal funds rate. Through market pressures, remember, they're not setting the federal funds rate. That's just something negotiated through by the banks. But it's ultimately going to lead to that. If they increased it enough, all right, I got kind of crazy off to the right here. If they increase, and I could have changed the slope, but I didn't want to add anything screwy onto there. If we went far enough, we could potentially push the federal funds rate up high enough to IFF3 with that increase in reserves that we hit the upper bound. And then, of course, once we hit this upper bound, it doesn't matter how much more we increase reserves. We're just going to have reserves being supplied to the market at the discount rate. Okay, questions on that? All right, our fourth policy tool, our new fourth wild card, is the change on the interest on required reserves. Number 4, change in the interest on required reserves. So go do home base. Reserve demand, reserve supply, some sort of current equilibrium federal funds rate for starters, and some quantity of non-borrowed reserves floating around in the system. If we change the interest on reserves, what's going to happen? What happens to our elbow? Does the whole thing shift? Or does one arm get longer or shorter or up or down? It's just going to move up demand. Is the whole thing going to move up? No, right? So by changing this lower bound, the new interest rate on reserves is going to be R2 and not have any effect. In other words, IFF2 is going to be the same as it was before. Of course, if they jack it up high enough to R2D, now we have the new interest on reserves having an effect on the federal funds rate, moving it up because the intersection point is going to be here. So, what's interesting with this particular case is that nothing ever changed with the quantity of non-borrowed reserves, right? No matter where I was at, we're just potentially impacting the federal funds rate if they raised it up high enough. Okay, so that's all of the cases. Questions there? All right. I'm going to make a last comments here, but we'll save writing it out. So there's different types of open market operations. One of those is dynamic operations, which is kind of their long-term targeting for monetary base. And then the other one is when they're trying to be defensive of a position for a kind of a short-term fluctuation. And I think this was brought up on our tour about the repos, repurchase agreements. So the Fed does these repo agreements with people who are involved with lenders, and if they're selling a bond, maybe just for a 15-day period or a 10 to 15-day period, and they call it a repurchase agreement because when they sell the bond, they sell it, and Kurt doesn't have any money, so I'm not going to take his money, but I'd be right, that would be the open market sale on. But in writing right away, I have a repurchase agreement that says after 10 days, Kurt agrees to sell it back to me. And so it's a temporary manipulation of the market. And so 10 days later, we swap places again. And then there's a reverse repurchase agreement where if you're doing an open market purchase of a bond, I'm going to buy the bond. Did I already do this one? No. I'm going to buy the bond from Kurt. He's going to agree to buy it back from me. So it goes both ways for an open market sale and open market purchase. Those are the repo agreements, repurchase agreements, and then this reverse repo agreement. All right, we will pick up there on Monday. Have a good weekend.